Watch. So welcome everyone to Oreana's latest webinar series. It's great to have you and hope you're all doing well. Before we start, just a few household issues in terms of the webinar tools. I'm sure you're all familiar with this by now, but just to remind everyone that everyone will be muted during the webinar. This webinar will be recorded and we'll be sending through a copy of this to the attendees. In terms of the question and answers, there will be a question and answer session at the end, towards the end of the session. So please type in your questions in that particular box, and then Matt and I will be able to attend to it then. But if we are running out of time, we'll definitely reach out and answer your queries then. Okay. In terms of the speakers, it's a pleasure for Matt and myself to have you all here with us. So we are senior wealth advisors with Oreana Private Wealth, as you know, based here in Hong Kong in Quarry Bay, and we'll be going through the presentation with you. In terms of the agenda, we'll be focusing on the Australian federal budget announcement, which was just announced in the last few days. We'll also be going through some key strategies and consideration. In terms of the federal budget, what Matt will be going through is a bit of an economic update of what is the current state of play, I guess, back home, as well as sifting through some of the budget announcements and focusing more towards those announcements that's more relevant, if you like, for people that are living overseas, such as you and myself. I will then continue that theme along and look at some key strategies and considerations for expatriates looking at their wealth creation plans, and we'll close off the webinar with some question and answers. So without further ado, Matt, would you like to take it from here?
Yeah, thanks, Andre, and thank you for joining, everyone. I'll bring up my screen now if that's coming through. So the 2022 federal budget announcement the Australian government handed down Wednesday evening was not the typical type of pre-election big spending budget you may expect. Somewhat constrained by the current level of debt and risk of spurring on inflation by big spending, the budget handed down what has been aimed at being fiscally responsible in the current economic environment. Numerous challenges are present for the Australian economy, though, including the eye-watering debt that's accumulated from COVID, war in Ukraine, rising inflation, and flooding throughout Eastern Australia. However, despite the challenges, Australia's economy has grown significantly higher than initially forecast at 4.2% in December 2021. Unemployment is currently low at 4% and is expected to fall even further to 3.75% by the September quarter. This, along with soaring commodity prices, has significantly improved government revenue. The Treasurer forecast a budget deficit of $78 billion in 2023, which is lower than previous estimates of $90 billion, or almost $90 billion, as recent as in December, before falling to $43 billion, halving this figure by the end of forward estimates in 2026. Wage growth has been historically slow, currently at 2.3%. However, the government is banking on a tighter labour market pushing up wages, which are forecast to grow at a rate of 3.25% in 2023 and 2024. If wages can grow at these forecast numbers and Australia can continue inflation, this will mean wages growth will be set to take over inflation. This is really good news for Australians if it comes through. Net debt is tipped to hit an eye-watering $715 billion, which is 31% of GDP in 2022-2023, before peaking at 33% in 2026. However, Australia's debt level actually remains quite low compared to most other developed countries. So there is some good news there. So onto the spending packages announced by the budget. There were several measures introduced to reduce the current pressure of rising costs in Australia, particularly for the lower middle class. An increase in the lower middle income tax offset by $420, and many social security recipients will also receive an eligible one-off $250 cash bonus. The Medicare levy threshold has also been indexed, and I think probably the most talked about, it seemed, was a temporary reduction in the fuel excise for 6 months to help some of these rising costs of living for Australians. Small businesses have been provided tax deductions for training and improving skills for an increase of 20%. Further to this, there's been an additional 20% deduction for business expenses and depreciating assets that support digital adoption, such as portable payment devices, cybersecurity systems, or subscription to cloud-based services. The government will also provide $450 million in 2022 to Services Australia to respond to emergencies, including the COVID pandemic, disaster relief payment, and also the delivery of the Australian disaster recovery payment in response to the flooding. The pharmaceuticals benefit scheme is also set for a $2.4 billion shot in the arm over 5 years, adding new medicines to the list, and $547 million for mental health and suicide prevention support packages, including $52 million for Lifeline. There were also changes announced for the paid parental leave, providing up to 20 weeks in fully flexible shareable scheme for eligible working parents. So that's good news. And then on to superannuation. I guess being an election year, the budget was pretty placid around making any changes to superannuation. So the most notable changes this year were the temporary extension of the minimum pension drawdown of 50% again for another year, and superannuation guarantee, which is increasing to 10.5% from July 22 for that's all important for anyone that may be relocating back to Australia. So, as mentioned, it was a pretty safe approach to the budget this year, I would say, with not a lot of introduced changes. So I thought I might just cover off on some of the legislated changes from previous budget announcements that are set to come in from 1 July. So the first being the work test. So from early days of Australia's super system, contributions have always been tied to employment. So you needed to be working to make or receive contributions into superannuation. Historically, older Australians wanting to make superannuation contributions who were over age 65 would need to meet what was referred to as a work test. So this was 30 hours in 1 month. This was then increased to age 67 in previous budget announcements. However, from 1 July this year, the work test is actually being removed for non-concessional, which are after-tax contributions, and salary sacrifice contributions to allow older Australians to build their concessionally taxed super balances. The next one is a bring forward rule. So Andre will speak a bit more to the benefits of this strategy later in this presentation, but the current limit on an after-tax non-concessional contribution is $110,000 per annum. The bring forward provision allows eligible Australians to effectively make a total of 3 years worth of contributions in 1 year. Previously, there was an age limit to age 65, which then extended to age 67 with the work test. But from 1 July this year, this is actually being extended to age 75 if your super is below the transfer balance cap of 1.7 million. So this makes planning for retirement a lot easier, and also in particular for older Australians that are heading home to Australia to add to their super. The next change is a downsizer contribution, superannuation contribution. So if you've reached the eligible age, you may be able to contribute up to 300,000 from the proceeds of the sale of your Australian home into superannuation. The contribution is not subject to any contribution caps. So for a couple who have just sold their home, saving for retirement, this presents a pretty good opportunity to add to your concessionally taxed superannuation. The current eligible age is over age 65, but from 1 July, the eligible age is being reduced to age 60. So there's some eligibility criteria there you need to satisfy. The home must be in Australia, has to be in Australia. You have to have owned or your spouse have owned this for at least 10 years, and the disposal must be exempt or partially exempt from the capital gains tax. So it has to be considered your home. The final one here, so the first home super saver scheme, I just thought I'd touch on this as well. This was introduced in 2017. Voluntary contributions can be made to your super, which can then be withdrawn to assist the purchase of your first home. Previously, the maximum was $15,000 per annum that you could put into super, up to a maximum balance of $30,000. From 1 July, this has actually been increased to $50,000. So onto the elephant in the room for all of the Australian expats, particularly those of us in Hong Kong, where there's no dual tax agreement with Australia. Now, there was actually zero mention of the tax residency proposals that were announced in last year's budget. I'm assuming, again, that this being a pre-election budget from the government, maybe they didn't want to rock the boat any further on this, or perhaps proposals are being considered to be amended, which is sort of what I'm hearing privately. But I think you can be rest assured, and we're seeing that these changes are actually baked in. So the intention is very clear that I'm pretty sure this will be coming in at some point. However, highly unlikely, or almost 99% sure that it won't be coming in from 1 July this year, but still something to be mindful of for future years. So with that being said, I thought I'd just run through a recap of what the current proposals are in place. So current tax residency rules as they are today, they're based on your intention to return to Australia and being determined as a tax resident. So there are several statutory tests that currently determine your tax residency. These are the resides test, physical presence, intention, excuse me, family or business ties. There's the domicile test, unless you can satisfy your resident elsewhere. The 183 days test, which means you're half the year in Australia, so you become a tax residency resident. And then there's a Commonwealth superannuation test that applies for government employees. The new proposals that are in front of us right now, are intended to eliminate a lot of the grey area of intention and to provide a combination of bright line plus secondary factor tests. So the primary test is pretty clear. If you spend 183 days in Australia, you'll be considered a tax resident. If you are spending less than 183 days, then you need to look at the 4-factor tests. So the secondary test here is a bit on the screen, but just stepping through it. The secondary tests include tests for residency in terms of whether you are spending 45 days in Australia. If you did not spend 45 days, then you're a non-resident. So if you're under 45 days, you're fine. If it's more than 45 days and less than 183, this is where those factor tests come in. So you need to meet, if you meet two of these 4, plus the 45 days, you're going to be considered a tax resident for the year, for the financial year. The first one being the right to reside permanently in Australia. So this includes citizens, permanent residents, most of the people on the line here today, I'd imagine. So, which means if you can basically, you have the right to reside in Australia permanently. Australian accommodation. So if you have property available for your use when you come back to Australia, this can include an empty property for the use of when you're back. It's not intended to include like a granny flat that you might be able to stay in of your rental apartment. It's not really supposed to be the case, but if you've got an empty property in Australia, that's going to meet this factor test. Australian family. So if your spouse has gone back to Australia and or your children under the age of 18, on an ongoing basis, you can be you'll meet this test. And then finally, this gets a lot of us expats as well, the Australian Economic Interest Test. So if you're either employed in Australia or you're seen to be actively participating in carrying out a business, or Australian assets, taxable assets such as Australian property, significant cash in a bank account, or an interest in a family trust. So if you're a beneficiary of a family trust, you're going to meet this economic interest test here. So if you do satisfy one of these tests, you then need to look at whether you can cease residency the following year. So included in the 2019 tax paper, there were also cessation of residency tests that you need to be mindful of as well. So basically, the first is based on the employment test. So if you satisfy the listed employment rules, you'll be a non-resident from the day you leave Australia. But there are a few listed, satisfactions that you need to meet as well. So residing in Australia for the 3 prior income years, being employed overseas, you need to have a contract that shows that you're going for at least a period of more than 2 years, having accommodation available in the place of employment for the entire period, and spending less than 45 days in Australia again. So circling back around to that day counter rule. If you do not satisfy all of these rules, you'll need to determine if you're then a short-term or a long-term resident in determining if you can cease being an Australian tax resident. So just working through these, if you'll be a short-term resident, if you've been in Australia for less than 3 years, and you're a long-term resident if it's more than 3. So short-term residents, this can be if you return home for a year, or if you get caught in this net and you're determined a tax resident for, say, 1 year under the new rules. Then you have to look at, have you spent less than 45 days in Australia and meet less than 2 of the factor tests? If that's a yes, you're a non-tax resident from the day you leave. If it's a no, you'll remain an Australian tax resident. The long-term residency one here is a little bit more tricky. So this is existing long-term Australian residents more than 3 years, the previous 3 years. So then you have to look at, did you spend less than 45 days in Australia again in the previous 2 income years? If that's a yes, you're a non-tax resident. If it's a no, you'll remain an Australian tax resident. So basically, if you're leaving Australia for a period of time not related to work, or not meeting all of the previous 4 tests on the previous slide, you can continue to be considered an Australian tax resident for up to 3 years. So again, just reinforcing, these rules are not in yet, but as we said, we think the intention is very clear that it will be coming at some point. What that looks like, the day counter, again, it's unclear until it does come in, but I think it's really important for Aussie expats that may, or people returning or thinking about returning to Australia. This tax residency is coming on the horizon pretty soon. So with that being said, over to Andre to talk through some of these strategies that might be able to mitigate your tax implications under these rules, and or if you are in fact relocating to Australia permanently. Over to you, Andre.
Yep, sure. Thanks, Matty. Thanks for that. And so what I'd like to do for the rest of the presentation is just to go through some high-level considerations, if you like, of looking at your wealth creation plan, especially from a standpoint of you being an expatriate or an Australian non-resident, and some of the high-level, if you like, considerations that you can actually put in place or think about anyway when you're looking at what the next step is. Things are pretty volatile out there, and there is Matt and I are seeing a more, an increased, if you like, amount of inquiries in terms of what does repatriation look like, and people putting forward their repatriation plans. So what I'd like to do in the remainder of the time really is just go through some high-level considerations, strategy considerations anyway, of things that you'd need to be aware of. So from a wealth creation perspective anyway, and a lot of these things are something that you already probably understand, but it's good to put it in perspective of how it looks like. But being overseas, one of the benefits really is using that time to your advantage, and continue, if you like, any type of wealth creation plan that you've started either when you were still in Australia or when you were when you were just starting to work and live overseas. One of the concepts that you have really is sorry about that. I'll just do that again. So apologies for this. So one of the key concepts really is what's called diversification. Not putting your eggs in one basket. You probably heard of that quite often, but it's probably something else to try to really implement it as part of your investment plan. So here we've got the different asset classes that can really help you in terms of growing your capital in a sensible manner. And what I mean by sensible is really not really focusing on just one asset class, because as you know, different asset classes have different returns characteristic, different volatility or risks, as you can see currently in terms of for instance equities, they are impacted by really a lot of different things. Properties are impacted by a lot of macroeconomic factors, for instance. So it makes sense if you're looking at a long-term investment plan to have different pots, if you like, of your investment being exposed to different asset classes. And this can actually be customized depending on what your overall risk appetite is. The riskier your appetite is, obviously the more access you have to more growth assets such as equities, and probably the more capital stable or more conservative your approach is, then it can be customized to more safe asset classes. So a mixture of that would probably be optimal, and something that you need to be aware of if you're looking at your overall plan of what you already have in place or what you'd like to put in place in the future. Now, continuing on that diversification theme, if you like, is really what type of available cash do you have, or what type of equity do you have available that you can actually place into these different type of investments. So here I'm talking about probably some the available cash that you might already have. As you know, cash from a growth perspective probably doesn't doesn't probably provide the opportunities that say equities or different investment classes have. So an opportunity here is to look at any available cash you have, either from a lump sum perspective or any regular excess cash flow that you have, and expose it to these different asset classes. Alternatively, say for instance, if you do have an investment property back in Australia, for example, and you have equity in that particular asset, so the value of that asset is much more than the loan amount or the liability side of things, that we can use that available equity to actually expose it or access these different asset classes to help with your overall wealth creation plans. So that's what we mean by diversifying your liquidity and your equity, if you like. And for those of you that are looking at Australia at your end point, and by that I mean at some stage, I guess your tour of duty overseas will point to you returning to Australia permanently, or you would like to permanently retire in Australia at some point. Then superannuation becomes an important part of your consideration, because bar any other tax structures in Australia, superannuation is the most tax-effective tax structure for you to actually build your retirement savings upon. This is because of a couple of factors. The first is contributing. You can actually contribute into superannuation in a tax-effective manner. Yes, there are limits of how much you can contribute, but there are there are instances in which you can actually contribute into superannuation and claim it as a tax deduction. So if you do have any tax liabilities in Australia, one of the ways to mitigate that is to contribute into superannuation, right? While your funds is in this superannuation environment, it is actually concessionally taxed. And what I mean by that is, any capital or any type of capital growth that it enjoys due to the returns in that particular investment in superannuation is taxed at at a maximum of 15% or even less. Or the average tax of capital in superannuation is around 10%. Compared to investing outside of the superannuation realm, where taxes can be up to 30-40% because of Australia's highly taxed environment, superannuation becomes quite an attractive alternative for that. Fast forward to the time when you're ready to actually start a pension, or when you're ready to down tool from employment and wanting to fully retire, then when you start a pension in superannuation, both the capital and the income that you're receiving are actually tax-free. That's actually that makes superannuation one of the very few tax structures in Australia that can provide you with such an outcome. Tax-free, capital growth, as well as tax-free income when you are receiving it as an income. Obviously, one of the drawbacks of superannuation is this preservation age idea, the idea that you must reach a certain age for you to access your super, but also not only reach that age, but also retire from the workforce. So that's the only, the only issue in terms of, investing in superannuation, the accessibility issue. But if you think about it, right, if you do want to invest for long-term and you want to invest for your retirement plan, preservation is probably not the worst idea in the world, right? You probably want to put some funds in an environment where you can't actually touch it until you actually need it, which is in retirement. And we'll talk about some of the opportunities in contributing to super later on in the slides. The next thing I want to talk about really is in terms of, for those of you that actually have property in Australia, investment property, we do see a lot of instances in which, for a lot of you, what you have done is you do have your main residence in Australia. You have actually transferred overseas for a limited amount of time or a prolonged amount of time, and you have rented out that main property as a rental property, if you like. In terms of what you'd like to do with that property, or your goals or aspirations for the property, the first point of consideration is what your tax residency is, right? As Matt alluded to, most of us would be seen as an Australian non-tax resident, which means that we will be taxed differently to, say, an Australian resident when it comes to what to do with that property. If we decide to sell that property while we're a non-resident, then what's going to happen is that we won't be able to benefit from the capital gains concession that we receive if we were an Australian tax resident. Currently, if you hold something for 12 months or a property for 12 months and you are an Australian tax resident, you are able to receive up to 50% discount of any capital gains that you have crystallized. For instance, if you bought a home for $500,000, you sell it for $1 million, that's a $500,000 gain. If you held that property for 12 months, you're able to halve that gain and only having to claim or have half of that capital gain as income for that tax return. As a non-resident, we don't actually have that luxury. So the point there is avoid selling any of your Australian property while you are non-resident. One of the questions that we get in this in this field is, Andre, what about if it's my main residence, right? Don't we have that main residence capital gains exemption? The answer to that is a few years back, around 2 or 3 years ago, the government actually made it even tighter in terms of the ability for you to claim the main residence exemption if you were a non-resident, meaning that even though it's your main resident, but because you're a non-resident, you don't get that exemption anymore. So back to that point, avoid selling your Australian property while you are a non-resident. One of the other things that you can benefit though from is what's called a 6-year rule on homes. I alluded to the fact that if you have a main residence, you have what's called the CGT exemption, right? So what you can do is, and again, it depends on the timeline of you being a non-resident. So if you are a non-resident for, say less than less than 6 years to be safe, right? So for instance, in year 1, you have a main residence, right? You go to Hong Kong or Singapore for your, for your role, for your overseas role. You keep that main residence and rent it out. While you're overseas, you don't have any other main residence. You're actually renting while you're overseas, which means that you only have that main residence as your only principal residence. You have up to 6 years to claim that as your main residence. And the significance of that is when you come back to Australia within that 6 years, right, and sell that CGT, sell that main residence, you can still benefit from that capital gains exemption, right? You can still be able to sell that home while benefiting from that capital gains exemption that's available to non-residents. So it's available to Australian tax residents. Everyone's situation is different. So please, if you are in this category or looking at some of these strategies, reach out to Matt and myself, and we'll be able to talk to it in more details. And so that's the 50% CGT discount bullet point. And that's what it alludes to, the fact that if you're an Australian tax resident, you can get a 50% capital gains discount on any capital gains that you crystallize in that year. For a non-resident, that's actually not available. So it's very important for you to determine your Australian tax residency and when you are able to sell that Australian property that you have. The last two pieces is probably more operational, making sure that you maximize any deductions that you get from your investment properties, because of the fact that non-residents are taxed differently to Australian tax residents. And there is the ability to carry forward any tax credits, even though you're non-resident, for your future use going forward. So just continuing on this theme of property and creating wealth using your, assuming that you do have property back in Australia, one of the things that you can actually do is you can maximize the equity, the available equity that you have in your property. Say, for instance, you have a property that's valued at 500,000, given the property price hike, if you like, that Australia has experienced in the last 12 months. It's probably more like 600,000 now. But I digress. If you have a property of say 500,000, there's already an existing mortgage of 100,000. Then there's still another 400,000 equity that you can actually unlock. What can you use that 400,000 equity in? You can actually use it to either invest in different assets, such as equities, or you can actually use to conceivably buy another investment property. Right, so that really is optimizing, if you like, your equity position to create further wealth. Yes, you are increasing liability, but you're doing so in a tax-effective manner. In the event that the deductions is actually less than the rent that you're receiving in this new, or the income that you're receiving in this new investment, that's what you call negative gearing, because the income is less than the deduction that you actually get. You can then again build up the tax credit situation going forward as well. The table on the other side there, on the bottom here, actually talks and probably reflects my earlier point, in which tax treatment of non-residents and residents is very different. For non-residents, you don't get these tax-effective tax-free thresholds, if you like. It goes straight to being taxed at 32.5%, which then suggests that if you are actually investing or being able to actually claim a deduction, it's actually double the value compared to if you are an Australian resident. So it's actually important for you to consider any type of tax effective strategies when you are investing, especially investing in Australian soil. I'll then actually follow up that point in terms of wealth creation to retirement planning. If you do have superannuation in Australia, I suspect most of you do. Whether you'd actually keep a keen eye on it or not is another matter. But I suspect that prior to you going overseas to Australia, overseas to Asia or other parts of the world, you have actually started, commenced or employment in Australia, and thus might have some superannuation back home as well. Some of the things that you'd need to have a look up, a bit of a checkbox, if you like, is looking at the investment options, making sure that it is invested in line with your growth or the type of risk profile that you're looking at. Usually, especially if you have an industry super, you're actually invested in some type of pooled investment asset class or some pre-mixed investment composition. Whether you're comfortable with that or not is another matter, but that's something that you need to check, making sure that you're aligned with the investment strategy. If you are looking at more of a customized manner, customized approach to your investments, speak to Matt and myself, and we'll be able to just see, what we can do in that space. The other part is to consolidate your superannuation, making sure that you have more. If you do have, I guess, different pots of superannuation elsewhere, it makes sense to consolidate, making sure that it's more efficient from a fee perspective, but also make sure that you're cognizant of any type of insurances that you have in those different superannuation points. One of the other parts is also making sure that you're comfortable of when you are able to access your superannuation. What is your preservation age? Quite some time ago, the default, if you like, age is 55. 55 and retired, you can receive your superannuation. Superannuation legislation has changed significantly since then. Now it really depends on what your date of birth is. For most of us, it'll be 60 as a rule of thumb, but depending on your date of birth, it could actually be earlier than 60. So it's an idea to actually, check out what your preservation age is. You can either Google it, ATO superannuation preservation age. It'll give you a table of what your date of births are and what the corresponding ages are, or just send us a quick email. Matt and I will be very happy to assist you in that respect. I spoke about consolidating and I guess the possibility of you having insurances in your superannuation. Now, especially industry super, there is going to be some basic insurance that might be already in place. One of the things that you can do is review those insurances. It may or may not be appropriate for you at this point, especially you being overseas. Your family has, family composition has changed, your asset space has changed. So it's good to have those insurances reviewed, making sure that it's in line with your current circumstances, and also in line with any insurance that you already have in place. The other thing that you need to be aware of is, when will you be able to access those insurances if anything does happen to you? Because superannuation is quite unique when it comes to when you can release funds. Obviously, death is one that can trigger that, but also there are some permanent disability clauses that you need to meet before you can actually access your insurances in that respect. So review your insurances, making sure that not only that it's aligned, but also if you want to keep it, making sure that you still contribute and there are sufficient amounts available for you to maintain that premium. The other part is making sure that you nominate your beneficiary. Remember, with superannuation, if anything happens to you, say for instance, if I pass away, my superannuation would go straight to my wife, being my nominated beneficiary. It won't go through my will, it won't go through my estate, it'll go straight directly to her, which means that it's very important that you understand who you can nominate as a beneficiary. The second part is also making sure that you are comfortable with that particular person receiving your assets, because it's not only your superannuation balance, but it's also the insurances included in that super that will go to that particular beneficiary. So make sure that your beneficiary details are updated in your superannuation and you're comfortable with that. Make contributions. Remember, superannuation, as I alluded to, is the most tax-effective way to build your retirement funds if you want to retire in Australia, or even if you don't want to retire in Australia. It is a very tax-effective retirement strategy. So contributing into superannuation will still make sense, even though you're still you're overseas, or you're in benefit of more lax or more reduced rates of tax overseas, because taxes in superannuation itself is extremely concessional, as I said, around 10 to 15% while you're in accumulation phase, and zero when it's in pension mode. So still consider making contributions into superannuation. This point is actually something that I'm guilty of as well, especially being overseas, is to update my contact details. Make sure that you keep in touch with your trustees, making sure that they're able to reach out to you and know exactly where you're at in terms of contact details, because they will still be able to report back to you, and things don't just fly off the handle, and before you know it, you've lost touch with your superannuation, and it just goes to the ATO lost superannuation pool, which is probably not the best superannuation strategy in the world. continuing on with this, the benefits of superannuation, what I've gone through the last slide is really a bit of a tick box on what you need to check. Now, what I'd like to highlight here is that, I guess, the effectiveness of actually contributing into superannuation. With superannuation, as I alluded to earlier, you can actually contribute into superannuation up to a certain limit and claim it as a tax deduction. So the limit's around 27,500 for this financial year. So you can, if you are in need of submitting a tax return in Australia, and there is a taxable liability, one of the things that you can do is contribute into superannuation and claim it as a tax deduction up to that limit that I've just noted. So it's quite tax effective really to do so. One of the lesser known benefits of being overseas and contributing to superannuation is this concept of catching up contributions. So in a nutshell, what happens is if you haven't actually contributed into super and claim a deduction for a number of years, you can actually play catch up. So I'll give you an example. If you have, say, a crystallized $100,000 of capital gains, which you need to pay tax on, what you can do is use this catch up concessional contributions, right? Method, right? So, for every year that you haven't contributed and claimed a deduction in Australia, you can actually claim it all in one go. So if you haven't contributed into super and claimed as a deduction for the last 3 to 4 years, I think the maximum is about 3 to 4 years at the moment, you can actually claim up to, say, about 100,000, which is 4 times 25,000 conservatively, and claim all of that as a tax deduction. So it can actually be quite useful upon you going returning back to Australia or having to deal with some type of lump sum capital gain liability if you're down there. The other part of non-concessional contributions will actually retain its character. What I mean by that is if you are contributing on an after-tax basis, it will actually remain tax-free while it's in superannuation. One of the other benefits that you'd want to consider, especially those of you that are over 60 and wanting to return to Australia and there is scope to sell your main residence, is this concept of downsizer contribution. As part of the federal budget, what Matt has alluded to is the fact that if you're now only age 60, as opposed to 65 previously, and you are looking at wanting to pump money into superannuation and looking at selling your main residence, you can actually put up to 300,000 of those proceeds into superannuation without having to worry about all the other contribution limits, right? So that that's quite an opportunity there to boost your superannuation savings without having to worry about any other contribution limits that's out there, and using, I guess, the proceeds of your main residence to put into superannuation and benefit from all those tax advantages that I spoke about when you are starting a pension in retirement. So those are the type of, I guess, considerations of contributing into superannuation in a tax-effective manner. And remember, the end game really is closer to retirement. Really make benefit or optimize really where to a point of superannuation being your main income stream in retirement in Australia because of that that tax effectiveness, if you like. Talking about tax effectiveness while you are still overseas. There are products or solutions out there, or offshore anyway, that you can actually consider if you would like to, I guess, maintain tax effectiveness of the investment portfolio that you've built overseas, and at some stage you wanting to return back to Australia. I've included 2 examples here that you can actually consider, and if you need further details of these 2 type of solutions, please reach out to us and we'll be able to have that conversation. One is called the portfolio bond, which basically is, if you like, is a tax wrapper, right? So you have your investment portfolio, we'll wrap it in this particular structure. And what it does is if you actually, retain that structure for 10 years, regardless of whether you stay overseas or where you go back to Australia, if you retain it for 10 years, you'll be able to receive the growth and any income that you receive after that 10 years, capital gains free. So it actually firewalls, if you like, that investment portfolio while you're still overseas, and even when you're actually back in Australia. It's low cost. There are some rules for you to to actually observe. For instance, you can't actually put more than 125% of your previous contribution, for instance, and there are limitations on withdrawing that investment while it's in that particular structure. But it's something that you'd need to that you'd like to consider if tax efficiency is something that you'd want to link towards the investment that you have overseas. The second is foreign superannuation. As the name suggests, it's more of a retirement planning tool, but similar to the portfolio bond, it does provide a degree of tax efficiency for your investment that you've already accumulated while you're offshore. It's open architecture, which means that you can put most type of investment programs or portfolio, you can wrap it under that. Unlike superannuation in Australia, there's not really a lot of caps that you need to deal with. And the withdrawal can actually be started at age 55, which is different to the age 60 preservation age that we have. Again, it's preserved to an extent because it's superannuation in nature. But for you that's looking for I guess a tax effective wrapper for your retirement funds, using funds that you have built overseas. Please talk to us, because these are the two types of investment solutions that we can explore for you. The other part is, they are based on private ATO rulings. Currently, those two are acknowledged as having that tax effectiveness that I've spoke about. And it is really acknowledged by the ATO currently. So it's something that you really need to have a look at if that's the type of objectives that you have. So again, as I also mentioned earlier, we are seeing a bit of a pattern of people bringing forward their repatriation plans for whatever reason. So what I'd like to put as one of the last slides here is really a bit of a checklist of what you need to attend to, making sure that it's the repatriation back to Australia happens as seamless as possible. Right. So before leaving, make sure that you obtain valuations of your assets. And that's really significant, because what happens is, the minute that you touch down in Kingsford Smith Airport in Sydney, or the Melbourne equivalent, you'll be seen as a tax resident of Australia, right? For the longer term. And the significance of that date is, from a capital gains perspective, that's what's called your cost-based date. So any capital gains calculations will be based on that date, the date that you become an Australian tax resident. Consider winding up any of your offshore trusts and structures, because remember, until you become an Australian resident, the ATO is not too interested in you, right? So that's an opportunity, really, from a timeline perspective, to make sure that you unwind a lot of those trust structures, sell off any shares or anything that you don't want to have exposed to Australian capital gains regime, right? This aligns to this also aligns to things such as termination payments, bonuses, employee share plan considerations as well. So making sure that you wrap up those type of arrangements before you become an Australian tax resident, to make it a much cleaner change from non-residency to Australian tax residency. And obviously settle your final tax clearance, be that in Hong Kong or Singapore or wherever you are, making sure that you leave that place in a clean slate without any tax liability hanging around. When you do return to Australia, it's a whole different ballgame from a financial planning perspective. Superannuation becomes quite an important part of it, making sure that you realign your overall investment strategy now that you're resident, because the tax outcome is very different. Making sure that you review your lending arrangements, making sure that if there's an opportunity to refinance, for instance, restart your Medicare is probably very important as well, and also attend to any general insurance covers as well. Okay, so hopefully this gives you a bit of a feel of what you need to attend to when you are getting ready to go back to Australia. And once you hit the ground, what's the other things that you need to attend to. Again, Matt and myself, we are both dual licensed, which means that we are able to assist you or provide advice from both perspectives, really, from a long-term perspective as well. So that's really it from a content perspective. Hopefully you found a lot of value from Matt's update in terms of the economics of Australia, as well as from a federal budget perspective, from an expatriate lens, what you need to look at, the Australian tax residency issue, opportunities in putting funds into superannuation and those type of other tax-related products. Remember that we're here to help. So if you are looking at a dual advice type of capability, Oreana Private Wealth is here to help you. We are independent. We are not linked to any any banks or any type of financial institutions, so we can provide that independent advice. First and foremost, our capabilities is strategic in nature, right? So we are looking at it from a holistic client view, not only just your investment, but from your overall financial health. We also have that institutional capability from an investment perspective, where we have dynamic and strategic asset allocation capabilities, making sure that the returns that you get is coming from a responsible source. From that, what I mean by that, it's coming from a risk managed type of view, making sure that you are taking risk, but you are taking it in a very managed perspective. So that's really it from me. So what I'd like to now just go through is using just attending some of the questions that's come through. Maddie, we've got a question here.
Yeah, I can probably give you a break now.
Sure.
Andre.
Okay, no worries.
Yeah, thank you. That was obviously a useful recap. Some of the strategies available. A few of the questions coming through here was, I've answered it online, but when will the 45 days residency start? Is it July 2022? So, I mean, given the fact that it wasn't announced in the budget at all, where we are right now, there's just not enough time to run that through legislation. So 99% sure, even more so, that it won't be brought into legislation from 1 July 2022 at the earliest. And it is intended to be a 1 July thing. So at the earliest, you can be pretty certain that it'll be 1 July 23. So it gives everyone another year at least to start planning around that. There's a latest article in the Australian Financial Review that came out today that most tax experts are at least seeing these measures as being baked in. So the intention is there, it will come in at some point, but very unlikely from this July. I had another question there come through in the Q&A. You may need to stay, where is it? Due to lack of flights, quarantines, and lockdowns, you may need to stay greater than 45 days in Australia. Yes, that's correct. So this was based on a 2019 tax paper, pre-COVID, despite being actually announced during a COVID budget. So there's a misalignment there. So therefore, there's actually no carve out at all in the current proposals for missing your flights, stuck in quarantine, can't get a hotel, that sort of stuff. So it's a strict day counter, and then the factor tests kick in. So just be mindful of that. Does that mean from 2022, 2023, we can still stay in Australia for less than 180 days and not be subject to global tax? So as I mentioned, there's actually a number of statutory rules that are currently used by the governments are looking at. So the first one is that 183 days. So if you're over that, very likely you're going to be a resident. The other tests currently are the resides test. So your intention to move back, family business. So even if it's less than 183 days, if you tick on the little playing card when you get off that you're intending to move back permanently, it'll be from that day that you land. So again, it's all around your intention at the time. And then there's also the domicile test as well. So if you can really, again, get tax advice on this if you're intending on staying more than or an extended period of time in Australia currently. But if you can prove that your domicile or your habitual abode is somewhere else, you should be okay. Please outline the tax effects on gains in super if arising from non-concessional contributions. So this is in relation to tax within super. Basically, it's 15% within the accumulation phase. There's also a discounting applicable within superannuation, so that's a third. So basically, if you think about it, if you're holding assets for longer than 12 months, it'll be a 10% tax on any capital gains and 15% on income.
Yeah, just to follow on what Matt is saying there, is that, once it becomes in pension phase though, there is no tax, which means that, the idea or, there is a opportunity for you to, crystallize anything once you have been in pension phase, depending where you are in timeline, right? But you're right, Matt, accumulation is 10%, but once it's in pension phase, there's no tax in capital gains. So it's still pretty beneficial to contribute into super.
Yeah, thanks, Andre. And I'll just fire off another one here, rapid fire. So what should I do with my insurance in Hong Kong before I settle in Australia? They are for investment type with life cover. So look, difficult answer generally there. Really look at your situation. A lot of these policies in Hong Kong, if you've held them for a really long time, and you've met that, I guess, that payment period, look, you might want to hold on to it. It really depends on what your situation is. What are you insuring? What are the risks? If it's an Australian mortgage, well, it probably makes sense to have an Australian policy. You take out the currency risk and a number of other factors. But you really got to look at the policy, the premiums, pros and cons to each. So I'd suggest reaching out to us directly on that one.
Okay, cool. So in the interest of time, I'll probably leave it there, Matty, if that's all right.
Yeah, we're coming up.
Cool. All right. So again, thank you guys for attending today's webinar series. Very happy to have you and continue the engagement with you. This recording and presentation deck will be sent to you. So if you do have any other questions or anything you'd want to further explore with Maddie and myself, please don't hesitate to reach out and follow us to keep posted of our upcoming webinars. Stay safe, everyone, and it's a goodbye for now.
Bye, everyone.